Welcome to this Killick Explains video. And I suppose naturally with bond markets seesawing all over the place and people paying attention to what was once a sleepy part of the markets, I thought for those people thinking of dipping a toe, I would cover how to approach bond investing. Some tips, if you like, in terms of the way to think about it, particularly for people who may not have gone into this area before. So, first of all, bond markets are unquestionably in turmoil as I make this video, October 2022, not the only market in turmoil. What do I mean by that? Well, bond prices have fallen sharply so far this year. That's driven yields up, which is a function of the fact that most bonds, IOUs issued by governments and companies carry a fixed coupon. All right, so as prices fall, that'll tend to drive yields up for investors. We've got huge volatility in a normally sleepy part of the market. I'll say normally for the last 2 decades, give or take the odd sort of rumble. And this is all pretty unusual. Bond markets don't generally behave the way they've been behaving recently. So before I move into how do you approach this suddenly volatile part of the markets in general, let's talk about what's going on. So why are bond markets behaving the way they are? Well, there are all sorts of reasons coming together, of which the very least one, in a way, is Russia's war with Ukraine. Other factors are here. The UK government seems to be changing course or threatening to change course in terms of the mini budget. Will it stick? Will it change? And so on every 5 minutes. We've yet to see whether the latest announcements will stay in place for long. Then we've had pension funds running into trouble with their hedging tools, these liability-driven investments, LDIs as they're known. So pension funds trying to stay on top of contracts they signed when markets were much less volatile and interest rates were much lower, having to liquidate bonds, which is affecting the price of them in order to stay on top of margin calls. We've got the Bank of England dipping a toe back into the market, buying bonds or certainly threatening to relaunching QE, just as everybody thought they were going to do the opposite and take their foot off that accelerator. We've got the bond vigilantes waking up all at once. These are the big institutions, the banks, the traders, punishing poor decision making as they see it. And of course, underpinning all of this, inflation is still running well ahead of any central bank target, and interest rate policy is playing catch up, especially outside the US. So all of those things have weighed on bond prices and pushed up yields and made a normally quiet market pretty volatile. Now, this is all a bit of a double whammy for investors. So some of you watching this video may be thinking, well, don't like the look of this very much. I mean, number one, I don't understand bonds, or I don't think I do as well as I do equities. And number two, I don't like volatility much. But actually, amidst all of this, well, chaos, frankly, some people would say it is, there are opportunities for investors with the right approach. So bond yields are, by historic standards, very high right now and way above, bank deposit account rates, for example, and even substantially above, in some cases, what you'd expect to get as a dividend yield on equities. So for those people looking for some sort of income return, suddenly this space looks a little bit interesting in a way that it never has for donkey's years. Price swings don't have to matter in this market. Now, what do I mean by that? What I mean is if you buy an IOU and hold it all the way through to maturity or redemption, and assuming the issuer doesn't get into trouble, doesn't go bust, which is highly unlikely if you think about it with, say, the UK government, fairly unlikely with a highly rated company or corporate as they're known, then you will get the yield on offer because all IOUs with a fixed term are redeemed at their so-called nominal value, and that's fixed. So as long as you hold the bond all the way through to that point, you don't have to worry about price swings in the meantime. All right, and the current environment, volatility in any market creates opportunities and bargains. It creates situations where if everything's marked down together, if you pick through sort of that rubble, if you like, you will find bonds which are, frankly, probably cheaper than they should be. Now, what should potential investors thinking? Well, okay, Tim, this sounds a little bit interesting then. What sorts of things should you think about? What you shouldn't be thinking is, I'll try and jump in and pick out a bargain bond. Number one, that is like single stock investing, not advised in most cases. And number two, this is not a market that's open in the same way to retail investors as the equity market, but there are ways in. The question then becomes, what should I be thinking about and what's the best way in, for example? So diversification is pretty important in most cases. Now, you don't want all your eggs in one basket here any more than you'd want it anywhere else, like the equity market, for example. So what about the access route? How am I going to get in? If I'm not going to go in and cherry pick individual bonds, even assuming I could, which I think in most cases you'll find you can't, then you've got the, do I give my money to a fund manager with a bond fund, or do I set up, with a bit of help, some kind of direct investment portfolio made up of a collection of bonds, if you like? Now, the problem with funds, I'm not going to try and sway you either way necessarily, but the problem with funds is it's quite difficult actually to know what's going on underneath them, what's under the bonnet, and the high-profile collapse of one or two equity funds demonstrates that point in the last decade quite well. Number two, you can get a rush for the exit if they're open-ended, structured and buying illiquid things, and some bonds are quite illiquid. And number three, you have very little or no control over what's in there, when it comes in and when it goes out and so on. So portfolios, direct investments handled on your behalf do have a number of benefits, arguably, over just I'll write a check to a fund manager and see what happens. So we're going to think about the access route. We're going to think about time horizon. And what I mean by that is, where would these IOUs fit in if you're thinking about our three pots, rainy day funds, right? Not there. That's emergency cash. That's the leaky roof. That's suddenly having to find cash because your child at university has run into debt or something. That's that short call money, all right? Foreseeable calls on capital. Now here, things get interesting. So you've got a commitment 7 or 8 years out. You know what it is, you know roughly the amount, you're looking for something that will get you there. Well, an IOU with a redemption date that matches when you need the capital from a safe issuer that's unlikely to get into trouble or go bust could, I stress, could provide part of that answer. And then you've got your lifetime savings. That's saying, well, I've taken care of my emergency funds, I've identified any up and coming big commitments I might have to find cash to meet, just not yet. So the rest of my capital is working hard as lifetime savings. And bonds, fixed income securities can definitely play their role there too. Then you need to think about the appropriate risk level. So this can be done on your behalf, but it's really important, and this is where the jargon kicks in around bonds, and that can put some people off. Which issuer am I going to go for? What type of bond? Securitized, not securitized, senior, junior, and so on. What sort of duration risk am I prepared to stomach? Now, duration is effectively the interest rate sensitivity of a bond's yield, if you want to see it that way. Some are more sensitive than others. And then there's the credit rating. I mean, you can get a view from a set of professionals, Moody's, Standard & Poor's and Fitch being the big names in this space, on what they think of issuers, what they think of the specific bond. They combine the two to come up with a rating. It's not foolproof, but a AAA rating is a good place to start. All right. Now, if you're thinking this all sounds quite interesting and maybe there is an opportunity here, well, if you're not confident about IOUs and bonds, then my advice would be, if in doubt, talk to someone before jumping in. Okay, now some people will be thinking, crikey, I need some help with all this bond jargon. Well, killick.com/learn has a bonds tab. You can also search Tim Bennett bonds on YouTube. Other ways to get information about these IOUs, well, they're mentioned in one or two of my guides sitting next to me. That's editor@killick.com. And also there are occasionally contributions, usually contributions from the fixed income team, head of bonds research at Killick & Co. And for that, you want a copy of Confidant. And again, editor@killick.com is not a bad place to start.